Bum, 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 bum. Let's go here. We'll do this. Ray Dalio explains why you should avoid U.S. stocks and buy Mexico, Brazil. Good morning, good morning, good morning. Mexico, Brazil, and Japan ETFs. It's funny that he leaves out China there. Yeah, he's touting Japan. I don't. I just can't be on that. I can't be on that train. I mean, it's not really a shocker that I disagree with Ray Dalio, but I mean, konnichiwa. Good morning. Good morning. I'm never gonna financially recover from this. Um, okay. No date lunch. Just felt like the hair was getting a little out of control. I can't actually fit my hair under my hat anymore, so this is the only way to do this. Mass sell off today. Panic, run, cry. What's up, Pete Tony over on YouTube? I see you, brother. Yeah, guys. So one thing that I want you guys to do here is head over to Google. Everybody's got the Google tool. Okay, I'll do it with you guys. Everybody can see. Okay, market stock market corrections over the last 100 years. Okay. List of stock market crashes and bear markets. Are we ready? We're going to go through this, okay? 1637, tulip bubble in the Netherlands. Then we have the Mississippi bubble of the 1720s. Everybody remembers that, right? Then we got that South Sea bubble from the European stock markets, the Bengal bubble from the British East India Company. That's 1769. Let's move to the 1800s, okay? So 1893, 1896, there were just corrections. There was panic. Panic of 1901, 3 years, market was spooked by the assassination of the president in 1901, coupled with a severe drought. 1907, lasting over a year, markets took fright after Teddy Roosevelt threatened to rein in the monopolies that flourished in various sectors. Wall Street crash of 1929, everybody remembers this. Black Friday, right? Lasting over 4 years, bursting a speculative bubble in shares led to further selling as people who had borrowed money to buy shares had to cash them in. This is a good warning. Margin. Stay off it. Stay off your margin, please, and thank you. Recession of 1937, 1938. Lasted about a year. Share price fall was triggered from an economic recession within the Great Depression. Doubts about Roosevelt's New Deal policy. This could be very similar to Biden. and his promises. Okay, I'm not going to call it the bubble popping. Biden's got to get his ass in gear here. He's 2 months in. He's got the reins. He can't blame anyone else. He needs to stop playing partisan politics of trying to be popular with everybody and get shit done. That's why he was put in. That's why they gave him the majority, is to get shit done. So get shit done. That we're 2 months into this now, and we still don't have a stimulus is insanity. Forget trying to appease the Republicans. You don't have to. You won. That means that the majority of the U.S. people said that they wanted you to get shit done. So get shit done. Why we are still tiptoeing around this so that you can look like you're playing nice with everybody, forget that. Forget it. There's no time for that. But that's my 2 cents. The Kennedy slide of 62. Brazilian markets crashed 71, 73, 74. This is the UK. We had a crash. This is Africa. Black Monday, October 1987. 20% plunge on the S&P. Friday the 13th, mini crash, 1989. Failed leverage buyout of United Airlines caused a crash on the market. 1990s recession, right? Iraq invaded Kuwait, oil prices spiked, crash and recession. Japanese bubble pop, 91. Black Wednesday, 92. .com bubble, 2000. Chinese stock bubble, 2007. That's the Chinese hustle. Bear market of 2007 through 2009. Financial crisis of 2008. 2011 stock market fall. 2010 flash crash. 2015-16 market sell-off. Guys, these happen, okay? If you're gonna be in the market, why am I going down this long list of things that happen, okay? Because this happens. It happens. Duck me daddy, that's exactly the question you should be asking. Why in the world are we looking at this long list? Because this happens. It's a reality of the market. There are going to be corrections. There's going to be crashes. There's going to be... The reality is this, though, guys. Pull up the SPY now, okay? Everybody pull up your SPY chart, okay? SPY. I can only go back 10... how far is this going to go back? Let's go back 10 years. 10 years on the SPY, okay? So this has the 2011. This has... But let's go. I want to go back. I want to have the SPY as long as possible. So SPY over the last 100 years. 90-year historical chart on the SPY. Okay. Here it is. So 302 is where we're starting. 294, 265. Okay. And here's some of these dips and dips and dips and dips. This is the 1981. This is the big one. This is 1980, 1970s. And then the recovery. Okay. And then here's the dot-com bubble. Right? You remember that? Everyone remembers the 2008 recession. And then... So, I mean, is there a likelihood that we're seeing somewhere in the next 2 to 5 years some kind of a decline? Absolutely. Absolutely. But the reality is, like, this has to be a part of what you trade. You're not always going to have a hyper bull market. That's not going to happen. So you have to know what you're trading. This is why due diligence becomes more and more important, right? There's people that are getting so badly dicked on TA right now, where they are doing their technical analysis and saying, well, the chart patterns are showing this, and then one person puts out a tweet or the government makes a single announcement and your TA goes to shit overnight, right? So you got a couple of options here. If you're a day trader, go with Godson. I've never been a day trader for that reason. I'm a big fan of swing trading. Long-term holds are going to do especially well right now, but make your own strategies, guys. So don't be listening to anybody, not me, not Jim Cramer, not whatever. Make your own plays, know what you're doing, do your research, have your own strategy, play it well. If you don't know what the hell you're doing, you should probably be reaching out to a financial advisor of some kind, which is making now the perfect time to throw a disclaimer in here, okay? Disclaimer. I'm not a financial professional. I can't help you out, okay? But there are great financial professionals out there. If you're in the States, where the Rebels are, he's a streamer here on Twitch. Fantastic dude, knows his stuff. Don't sweat it, okay? Don't sweat it. Just reach out to people that know what they're doing. Rebels is a fantastic guy. I am talking to a Canadian firm tomorrow. They're guys that I know. They've got great performance. They're decent when they come to dealing with their clients. So I'm going to speak with them tomorrow, see if they're okay with me throwing their name out there as financial advisors. I would recommend people go seek out if you're in Canada. But yeah, I'm not in Canadian banks and utilities. I think the Canadian market is due for a correction as well. We are spending on debt without the GDP to back it. So, yeah, know what you're trading, guys. Do your own due diligence. Make your own plays. Think that through. Okay. If you are running scared because your holdings have gone down, well, I mean, what was your due diligence on the play? And I mean, we can go through a whole bunch of different plays right now, but know your due diligence. Know your due diligence. Know it. Live it. Breathe it. Own it. If you see your analysis breaking down and what you thought was supposed to happen didn't happen, reevaluate. Should you still be in the play if your analysis was completely wrong? Should you continue going forward? And I mean, I'm not trying to use Michael Burry because there was a few things that Michael Burry did wrong inside that Big Short. But what Michael Burry did do was he was dead set. What he saw is what he saw, and despite the market and the corruption and everything else that was telling him no, you're wrong, he looked at the numbers and said, I know my play. I'm going to play it. One of the greatest plays the market has ever seen. And it's because he had to create the play. It didn't exist until he created it. He went and created the play, and then despite the world telling him he was completely wrong, he held. So, is the market down today? Yes. What do we have today that has me interested? We've got Powell, obviously, speaking at 10, right? We've got Cohen doing a legal cannabis webcast today. Do you own any NFTs? No. You're going to have to explain what you mean by an NFT because this is not a term that I'm familiar with. Non-fungible tokens. No. No. I do not own any of those. What do I expect from Powell? Okay, guys, you ready for this? Everybody ready for the Powell speech? Here it is. Hi there. We are currently going to stay the course. We are not going to move interest rates in the short term because we are unsure about the current financial climate. Interest rates are going to stay where they are. We're not at this moment considering negative interest rates, but at some point we will possibly consider that. Followed by them grilling him with a bunch of questions and his responses on those questions being, that's not my job, that's your job. That's not my job, that's your job. That's not my job, that's your job. Ending with, where are we going moving forward? We will continue to support the market as we see necessary. Quantitative spending or easing will continue to be in place until such a time as we feel the market is stable without our assistance. And then it ends. Okay? This is the same thing that Powell has done on every conference for the last year. Stay the course, be calm, everything's fine. Money printer will go burr if necessary. And then the government goes, yeah, but what about this and this and this and this and this? And he goes, that's not my job. That's your job. You make the laws, you pass the bills, I work within the confines of that. Do I see negative rates being a possibility? No, I don't. No. There is no reason for the US to move to negative rates. There just isn't. And I know people right now are kind of doing the chicken with their head cut off and running around scared, but there is no need. Negative interest rates are not going to help at the moment. That's not what's necessary, in my opinion. And again, that's my opinion, but it's not necessary. Guys, just pretend it's Wednesday, right? Just pretend it's fuck Wednesday. Just pretend it's F Wednesday. If your whole portfolio is deep red, just pretend it's F Wednesday and move on with your life.
Millennial, something I don't know if you picked up anything, but I saw this and ignored it yesterday because I thought it was just stupid. There's nothing relevant as far as I was concerned, right? But this is the second day in a row. I think something's coming down the cybersecurity pump. I think either someone got hacked or there's something else afoot because
yes, somebody got hacked. Are you kidding?
Was Apple?
Yeah, it was Apple. There's a
Uh,
massive breach. That news broke this morning that there's a massive breach on like 50,000 um, Mac laptops, and they can't figure out why or how it happened. It's being called one of the most sophisticated hacks in the history of hacking.
uh, I ignored it yesterday because I was like, yeah, whatever. Like, never heard of this ETF bug or whatever, right? 2914, and then today, this morning, it was another 5.1 million gone off, and this is not public reported yet. So I don't know if this means it's good for cybersecurities because then Apple probably has to contract out shit, or if it's bad because Apple was using their cybersecurity stuff and they're fucked.
Um, so TPF and anybody else that's going to ask me about SNDL, it's going to ask me about Zomedica. Yeah, I'm not going anywhere. I'm not. And that's not me telling you guys that you shouldn't go anywhere. If you guys are getting seriously concerned about your positions and you're not willing to liquidate that entire position, you've got to make your own decision on your play. But for me, guys, you have to remember, like I started with $2,200. So everything that, as long as I don't decline below 2,200 on this portfolio, I'm green. So I'm not willing to run because my FA, my fundamental analysis on the Zomedica play was they had their first major device hitting the market end of March. Last I checked, we're not at the end of March. We don't have any idea about their pre-order sales. I think there's a lot of opportunity for comeback. Now, was there a better entry? Sure. I don't care though. I don't care if there was a better entry. That's playing wishes, dreams, and rainbow farts. That's not how I play. I got in. I'm at where I am. If I had cash to DCA, I might, but I'm not currently in that position where I can do that. So, am I going to exit Zomedica? No, I'm not going to exit Zomedica because my FA says heading into their initial sales at the end of March, I think Zomedica is going to run, especially in a market that's desperate for good news. I think it's going to be really, really crucial. Could there be a market crash in the coming months? There could be a market crash in the next couple of hours. If Powell gets on there and completely does what I don't think he's going to do and says that we're raising interest rates to 3.5%, the whole market could dissolve overnight. But you don't know that. So what I'm trying to do is just play the plays that I know. Do I see legalization happening this year in the States? Yes. Yes. So am I going to exit my pot stocks because they're down today? No. SNDL, am I going to exit because it's down? No, I'm not. I see a company that's debt free with $700 million. $700 million to go out and buy things up. And the whole market is dipping. That's good news for somebody that is debt free with 700 million cash, right? If the whole industry is dipping right now and people are desperate for cash and not sure how they're going to survive, and SNDL is sitting on $700 million to go buy up whatever they want, debt free with money to spend, yes, please. I'll take some more of that. All right. Get in, hit join. I'm going to go grab a coffee. I'll come right back, okay? All right, guys, we're back. Let's do this. Okay, so what we are going to do, exclamation mark plays to get in. We're going to run this. Of course, I'm playing against you guys. If you win, you get to pick the ticker that we watch going to the market, okay? What's your opinion on Tesla? Just a dip or correction? Where do you think it should be? It's aligned itself very closely with crypto, with Bitcoin. So as Bitcoin price reduces, so too will Tesla in the interim. My thoughts on SNDL is I'm bullish as hell on them. Debt-free company with $700 million to spend. There's a lot more DD behind it than just that, but just those 2 points for me is sufficient for me to have a bullish sentiment towards it. But what about dilution? What about market cap? They're not worth $3.5 billion. If you guys are going to quote market cap and valuation, you're in the wrong place, because this market right now, valuations and market cap mean sweet nothing. The tune of sweet nothing. Man, I am in dead last back there, huh? Yep. Look at Millennial go round and round and round up there. Anonymous, I just gave you the opinion on it. Oh, okay. Want to make sure you guys could hear me there. You were. Oh, Saki sneaks in at the end, steals it from X Flame. Saki, you get the pick. You get the pick. What's it going to be, Saki? What's it going to be? Okay, let's check news as we head into the market, guys. Bitcoin back down to under 50K. We're looking at around 48.7 right now. Earnings that we had, big earnings. Let's see. Go here, go here. After the close today, guys, these are the companies reporting. Let's see what we've got. Square will be a big one into it. Helion will be interesting for the EV sector to see how that's going. CCIV, RIP, by the way. Jazz Pharmaceuticals, that's here. Tabula Rasa, that's familiar. McAfee, I think, is a big nothing. Sprout Social, I didn't even know that was publicly traded. That's interesting. That's it. I don't see anything else that I'm super hyped on. Where's their earnings for the week? There we go. So tomorrow before the open, guys, Overstock, Lowe's, Bosch Health, Six Flags, Iron Mountain. That's a pretty solid day. Tomorrow after hours, Nvidia, Teladoc, Redfin, Bilibili, Viacom. So kind of big deal there. And then Thursday we've got Plug Power, Domino, Best Buy, Wayfair, Norwegian, Camping World, Etsy, Beyond Meat, Space, Nicola's Bone, by the way, in my opinion, Kronos. What do you think about NVIDIA earnings tomorrow? I think NVIDIA is going to look really, really solid. The fact that we are still in a shortage on chips looks really good for NVIDIA. As demand is high and supply is low, your top line will grow. Six Flags is opening up some of the stuff they had to shut down. We have a Six Flags in Montreal that we went to all last summer with the family. I've got season pass. We went. It was amazing. The lines were almost non-existent. There was almost nobody there. I had a blast. As far as how they're going to do, I think, so my opinion, guys, on parks like Six Flags, Cedar, Disney, all of those. The reality is people are not going to be traveling internationally, I don't think. Let's watch Merida. Okay, we can totally do that. People are not going to be traveling internationally, folks. I think that people are going to be traveling domestically, and that means that you're going to see a lot more camping, a lot more theme parks. I think SeaWorld, Cedar, Six Flags, they're all going to do really well. So later at Pan. Take it easy, man. I'm not from Montreal. I'm from right now. We live outside, like just outside, just north of the New York border, in between Ottawa and Montreal, so somewhere in that kind of zone. You don't believe in Bitcoin, but have Tesla shares. What can you do? You're thinking of taking profit from Tesla. So why did you get into Tesla? Would be my first question. EQL.
Millennial, can you link me the Apple hack thing?
Just Google it on Twitter; it'll pop up. I don't have a direct link.
Oh, it's
Lagos, thanks
Twitter.
for the
Okay.
follow, man. Mom and Pop Play, Trader Vic, thank you so much, guys. Barry, Big Harry Dingo, guys. If you're new here and you're just starting to follow, I don't like having people that are just lurking in chat, not doing anything. I'd rather get to know you, what you trade. The community's better when a whole bunch of people are talking. So let me know what you trade, how you found the stream. If you have questions, don't hesitate to ask. I make a point, even though it may take me a while to get around to everybody's questions or tickers or whatever. I make a point to try to get through all of them. So let's keep that in mind. That's the bell. Okay, Mara, open that up, get this up, do this here. Redemption Stunt saying, look for Silver Sparrow. This is over 10 years on Mara, so that's not going to do anybody any good. Down to 30. Still holding AQB. No, I'm not. No, you guys can go to portfolio. This will take you to my portfolio. I'll keep that public for you guys.
I'm not seeing anything about it. I'm just seeing Apple make it harder to
There's
hack
links in
iPhones.
chat. New malware found on 30,000 Macs has security pros stumped. All right, guys. So here is the current portfolio. As you will see, November, December, January were quite kind. February, I'm still up almost 9% on the month, guys. I took wins earlier this month. The S&P is only up 5 this month. I'm still beating the S&P on the month. So over the last 4 months, I haven't lost the S&P. I'm still not losing. So will you ever start making YouTube videos? I'm live on YouTube right now. All of these daily live streams go back onto YouTube. They're there. They're cataloged and they're available for everybody to watch. I am over on YouTube. Whether I go back to creating itemized questions, that'll really depend. I do have a decent amount of time in the afternoons where I could just stop lurking around. Wait, I see a great. So I'm gonna open up this because Walt over on YouTube here is offering up some tickers that he'd like me to take a look at. So let me throw these in here and I will make a point of getting around to all of them and just giving you guys my quick overview and thoughts on them. I see some very familiar tickers here. So if you guys have tickers you want me to check, go ahead and throw that in there. We're going to watch Mary here for a little bit. I'll open the portfolio. The reality is, guys, this portfolio I started last year with $2,200. Right now, if I look at both the US margin and the Canadian margin that I've got, my count value is 26K Canadian, so that's about 20 grand Canadian, or 20 grand US. And then my US margin is currently 65. So I'm somewhere in the ballpark of 100,000 from 2200. I'm still good. And I know that it's showing unrealized P&L down 25 grand right now. That's not really sweating it for me. SNDL is $1.30 right now. I've got a 212 average. Zemetica, it's $1.63. I've got a 250 average. I'm just like I'm not sweating it because I look at Zemetica and I'm going, they sales is a coming and it's gonna go. As far as FTOC goes, guys, they've announced Payoneer. I think fintech is going to be strong into the year. I think Payoneer is going to make an announcement in regards to Bitcoin, so I think that that's going to be really, really, really solid. And then, SNDL, guys, you know that what I've done on that, but we'll break that down in a little bit here. So if you guys do have tickers that you want me to take a look at, I will probably be around till about 10:30 today, so just keep that in mind. Let's go over here, and we are going to go bump, 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 bump. Let's go. Okay, so if you guys have tickers, put them in, and I will add them to the journal here. We looked at these yesterday. Those are gone. I'm going to keep CIDM on here because I want to watch that. Okay, so Zemetica, guys, like I said already, Trueforma dropping. We probably see pre-orders first week of March on that. RZ, IML, WMC, AMC. Okay, save. Okay, Spirit Airlines, guys. Since the initial drop, I've been saying, in my opinion, I think that smaller airlines, smaller domestic airlines, are more likely to see a recovery faster. Now, that being said, look at the 10-year on this, guys. Spirit Airlines is about 37 right now. Over the last 10 years, its high was about 75. Pre-drop, it was closer to 50. I wouldn't be surprised with stimulus and as travel recovers, Spirit heads back towards that 50 for sure, which isn't a really terrible game, right? Like, um, yeah, it's not a terrible game by any stretch of the imagination. Options portfolio today down 7%. Keep in mind, guys, depending on what is said today, you could really see the market run green on what Powell has to say. So keep that in mind. But I do like Save. I do like Spirit Airlines. Love is the other one that I really like. Alaska Air, Hawaiian Air. Those smaller domestic flights, guys, I think those are going to be the big ones, okay? In regards to what's next. So let's save CTRM. Castor Maritime. So Castor Maritime was one of the hype stocks, guys. It is pushing for compliancy. It has not reached it then. This is the big news for Castor Maritime that I like, is that they've got two massive new ships and bigger ships than you had seen before. So these are big, 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 big for me. I think Castor Maritime is a really solid long-term hold in my opinion, because they've got the ability to ship like crazy, and that's where we are headed. Do you own any crypto, any ETH? I do not. I don't trade those assets directly. If I was to trade them, I would trade Mara, which I have traded successfully in the past. But no, I don't directly trade cryptocurrencies. Okay, next, I'm looking at OEG, Orbital Energy. Okay, so it's had a decent rise here. Solar farm construction leader. I like that. I like its positioning. Estimated revenue. Yeah, I like that. I like that a lot. Yeah, so far these are all tickers that I like. SNDL, guys, again, the play on SNDL. Okay, I guess I should be writing some of these notes in. Sales start March. Save. Smaller domestic flights. Stimulus. Travel recovery. Post lockdown. CTRN. Increased international shipping. Two massive new ships. OEG, solar farms. Where are they based out of? Houston. Houston based. Massive revenue projections 2021. Okay, SNDL, guys. Debt free. 700 million cash in hand. Legalization. Take a look at CBAT. Take a look at CCIV. Guys, just before I get to those EV plays, I do want to know how many of you here in chat are currently driving an EV. How many of you are driving an electric vehicle? Not driving a gas vehicle? Let me know in chat. I guess maybe I'll do a poll. Maybe a poll is a better way of going about that instead of let me do it that way. Are you driving an EV? Yes, no, hybrid. Right. There's the poll, guys. We'll pop that up there. That way I can just look at it real quick and get a clear number as to what's happening. But poll's up. Go ahead and place your vote in that. Trading views broken. XPEV? Yeah, I can add XPEV. What about I want one? No, I want one is not what I'm asking. I'm asking who is currently driving an electric vehicle. Not I want one. I want a condo on a beach on an island that I own. That doesn't mean I've got that. I want to know who currently owns it. Riding a bicycle does not count. I'm talking an electric car when I say vehicle. Okay, I'll let that poll run. Let's go check out NRZ here. NRZ, ooh, Residential Investment Corporation. Be very, very careful with REITs, guys. Be very, very careful with REITs. Mortgage forbearance is going to go through the roof here. I am not bullish on residential properties at the moment. I think we see a lot of people default on their mortgages again. 93% of voters are not driving an EV. That's about the confidence that I have in the EV sector currently. And given the absolute flood of EVs that are out there, I'm not a fan of residential REITs, guys. Commerce in major urban centers, fine if that's the REIT, but otherwise I'm not really interested. Well, I'll tell you why that stat is really, really important. It is based in New York, though. Look at their 2020 revenue. Negative 150 mil, and they're estimating 2.25 billion. Really? This is sketchy for me, guys. This is sketchy. For you to go from this to this, it's sketchy. I would have to do a lot more due diligence on NRG. A lot more. Qualify Tesla's dead for me. Qualify that. What do you mean? What is Tesla dead? Tesla 500? Tesla 100? Credit Suisse 2x leverage. I don't go anywhere near 2x leverage, 3x leverage. Especially, I'm not going to do it with a REIT ETN. That's just personal, guys. I don't play that. That's not saying it's not a bad play, or that's not saying it's a good play or a bad play. But in my opinion, I don't go anywhere near 2x, 3x leverage, especially in this market. Unless I might consider something to the bear side, but I'm not going to do that. 2x lev REIT warning. All right, WMC. This is a California-based REIT. AMC. I like Cinemark better. That's really the best ED I can give in that. CBOT. So this is one we've looked at before, guys. I actually like CBOT Energy because of their tie to lithium batteries in mainland China. This is the big one. They sell lithium batteries in mainland China. That's it for me. Their revenue projections are not crazy. 2017 they had a gangbuster year, but with the eco credits in China, them selling lithium batteries, Neo taking off, I honestly think that that's a huge play. So lithium batteries in China. ZOM just crashed. No, that's fine. Cybersecurity. I haven't spoken on cybersecurity, but I can definitely take a look at crowd. Um, CCIV guys, hype has come. Market is flooded. Who can name some EV companies in chat? Name some EV companies in chat. And I'm gonna grab my coffee and I'll be right back. But name some EV companies in chat. Try not to double up and try to see how many you guys can name. Okay, so you guys see all of these tickers, right? Does this market that is currently at about, we'll say, aggressively 7% of the market is interested in EVs, okay? Hell, let's go to 10. 10% of the market. 1 in 10 people are interested in driving an EV. Am I being fair? Is that fair? 1 in 10? So 1 in 10 want to drive an EV. That's a lot of companies that are hoping that 1 in 10 is going to float their company. I don't think that's going to happen, folks. Yeah, I would say less than 1 in 10 myself, but I want to be really generous and fair to that sector. Ford, GM, Tesla, CCIV, Aero, XPEV, Neo, they all want a slice of this pie, and I'm looking at it going, that's not a pie, man, it's a tartlet, and y'all are fighting over it. So my thoughts on CCIV is it was a SPAC play. You ride the hype and you get out. That's how we've been playing SPACs all along. That's how the analysis we did on SPACs is SPACs are all about the hype. Or if you want to hold a company for 10 years, that's the other play on those, right? I know a lot of guys that own trucks up here in Canada. We are in rural Canada. Most people here drive trucks. I'm telling you, nobody is lining up for an EV truck. Not even a hybrid truck. Unless there's a serious kickback from the government to encourage you to do that. Yeah, and pumps like that, I'd be okay with that concept of like, well, the bigger companies will buy them out. Tesla has no interest in buying out any of its competitors. They just want to watch them die. Ford and GM are already bleeding out their butt, right? Like they've got nothing left. They've got nothing left. They need this to survive. Okay, so guys, I keep telling you, like, I'm calm, I'm cool, I'm relaxed, right? I got you beat, Reese. I'm down 20% on the US side and another 15 on the Canadian side. $20 here, 15 here. I got you beat, man. I got you beat. So what are the events that we are aware of for the economy as a whole that we can expect to see by the end of the week here? Sorry, I just had to make a quick transfer in my accounts here because I want to make sure that I'm not in margin so that they can't call in my. They can't close my positions. All right. We got Powell today, right? We've got the stimulus by the end of the week from the House size. Like, yeah, guys, if you're in margin, that would be the big red flag. Okay, that would be the big red flag that I'd be waving. If you are currently trading on margin and you do not have the means to cover your margin, you need to seriously consider what you are doing and seek out financial advice because you are in a really bad position and you're playing with fire being in margin. Expect a margin call in this market as things decline. Expect it. So you guys will see. I just transferred over from Canadian to US. I have cleared any negative. I have no loan value. I have no loan value. I am nobody can see. No loan value. I'm in cash. No loan value. I'm in cash. That's it. If you are in margin, you are at risk in a huge way. Will this go down as a crash? I think currently it's going to go down as a correction. I don't know that we are at a crash yet. If I pull up the SPY, 381. I don't think that this is a crash, guys. And the reason why I say that is, let's go back a year. So look at this. Was this a crash? January into the start of February, was that a crash? How about October into November? Was that a crash? Or August into September? I don't think so. I don't think that these qualify as crashes. I think this is just typical market movement. We're at damn near all-time highs, guys. All-time highs on SPY are 392, 394. We're at 382. This is not so crazy. Yeah, Larthantos, that's exactly it. If you guys don't remember back here, we saw at least one, if not 2 to 3 market crashes or circuit breaker halts a day back here when we were trading this. This was a crash. This is not a crash. When we went from SPY 330 to SPY 218 in a month, that was a crash. This is not. This is not a crash. So the reason why I'm trying to stay calm today with you guys, and you guys have seen me do this day after day after day lately, of it's not a big deal, guys. And I know for a lot of people, they're looking at me like I'm absolutely psychotic and I've got a third eye or whatever because my portfolio is down, 13 grand on the US side, 4 grand, so it's like 3.5 there. I'm down like 16 grand today, right? But down isn't out. It's not lost. That 16 grand isn't gone. My portfolio, my unrealized P&L, Canadian is down 19 grand. US is down 30. So that's like 48 grand I'm down as a whole across all these portfolios. So from 130 grand down to down 40 grand from there, right? Like I'm down. It's crazy. Nothing has changed. My FA has not changed on any of my positions. Everything is still the same. I see a stimulus inbound in the US. Another $1.9 trillion. I see a fiscal policy out of Yellen and Powell that is very dovish. It's very supportive of the market. They're going to spend money ceaselessly. The plays that I am in are fintech, pot, and a confirmed FDA position. I didn't DCA. I don't have funds to DCA. No dollars to DCA. I did DCA on SNDL a little bit, brought it down to 212, but otherwise I have not. Yeah, I mean it, guys. This is just it. Yeah. Let's go back to looking. So XPEV again, guys. XPEV it's EV from China. If I don't like EV from the US, I'm not going to like EV from China, right? Crowd CRWD. All right, hold on. I got to do something here. Okay, we're gonna do two scenarios. Okay, no, we'll just do one big scenario. Let's do one big scenario. Okay, so here we are. We've got this, and then we're gonna do like we'll have a curtain over here and a curtain. Oh, I did that backwards. And another curtain over here, and then up here on the screen we're gonna have movie starring Dwayne the Rock Johnson with his giant muscles. Oh, look at my big muscles! I'm the Rock, and then he's shooting things and pew, 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 and then things are blowing up and there's fires, and then down here we have all the little people, right? All the little people, lots of little people. We're all watching a movie, okay? Everybody there? Okay, so we're watching a movie in the theaters right now. Okay? Bozo in the back of the theater, this guy, big idiot, this guy, yells out, "Fire!" There are two doors. One here, one. Well, I guess there's three doors because there's usually an aisle there and an aisle there and then a door. Right? Okay, so we got three doors. What are we going to do? Somebody has yelled, "Fire!" in a movie theater. It's a crowded movie theater. What do you do? Option the first. Oh, don't panic. Don't panic. Number one, don't panic is what somebody's going to do. So one of the options is don't panic. Option two, beat the shit out of the guy that said fire. That's a fair option. Step three, find the nearest exit. Step four, panic. Okay, so these aren't steps. These are different reactions to this, right? So knock the guy out that said fire because he's being an asshole. That's an option. What does that look like? That looks like anytime Jim Cramer, CNBC get on and tell you that the bubble is popping and they told you so, you mute them, block them, stop watching. Okay, that's how you deal with the asshole yelling fire. Okay, up next, panic. Panic can only be resolved, guys. The more knowledge you have, the less fear you have. So, do you understand what's currently happening in the market? Do you know? Well, what's happening right now in the market? We don't have a stimulus and we need it. Nobody's sure what Powell's going to say. We don't know what's going on with interest rates. We still have COVID. It's not gone. Biden's asleep at the wheel, right? Nobody knows. Nobody knows. So knowing that nobody knows, should you be running around scared? No. Is the market moving in one direction or the other indicative of somebody understanding something? No. This is indicative of people running for the doors. It's the fear and panic. Now, assess the situation was another one that we had, right? Assess the situation. Assess the situation is stop, look around the theater, look for fire. There is no fire. Okay. Or stop, look around the theater. Oh, look, there's a little fire in the back there. There's a little bit of smoke. And as you're assessing the situation, you realize that one guy's getting knocked out in the back of the theater. There's a bunch of people running for these two doors, right? They're running, screaming, and yelling, I want out of the theater. Meanwhile, you calmly make your way. You get up and you don't run, you don't scream, you don't yell. You calmly make your way to the exit furthest from the fire. Okay? Last option is this guy right here who goes, I'm digging the movie, and that fire is so small and irrelevant, it doesn't matter. I'm going to sit right where I am. This right here, guys, that's me. This millennial. Okay. Now, for those of you that know Martini Rita, wicked smart lady, really like her. She knows her crap. She and I have known each other for a whole year, right? This is Martini. She exited stage right calmly. I'm out. Liquidated portfolio. She's gone. Out. Bye. Gone. Okay. All of this is the rest of the traders that are currently buying, selling, trying to run, panicking, running each other over, thinking they're going to get out before a hedge fund's going to get out. It becomes a disaster. The whole world's losing their mind. Yeah. But the reality is, a couple of people will make these doors. And it will be the first ones to the doors, and it'll be the biggest guys to the doors, right? For me, I'm going to sit. Because I know that theaters have sprinklers. I look back, I saw a tiny little fire. I'm not sweating it. I'll get a little bit more concerned as the fire gets bigger, but to be honest, rushing the doors isn't going to help me out, right? Better yet, steal the good seat. Rock X. That's not a bad way to play it, right? I'm going to move up to the front row. This is great. Wonderful. But guys, this is the market currently, and I know that this looks like insanity right now, so make sure that you clip it, screenshot it, because this is the current state of the market. But the question you have to ask yourself is, are you part of the mob running for the doors? Right? Yeah, Walt, that's a great point. Walt's over on YouTube hanging out with us today, but had you not looked at the market today, you wouldn't even know. But guys, this drawing is literally it. Which one are you? Are you the guy sitting in the theater going, yeah, there's a fire, but I mean, it's like this big. It's some guy that, lit his movie ticket on fire or smoking a cigarette in the back of the theater, and I'm not going to sweat it. Or even a chair's on fire in the back of the theater. And you know that there's systems in place to manage that, right? Miguel, that's a large factor. It is Powell speaking today that has a lot of people uncertain about what's going on in the market, for sure. And the fact that stimulus hasn't been passed is the other big part of it. So are you going to be the guy sitting, chilling, and calm, cool, relax? Are you going to be the person that calmly makes it their way to the door? Are you going to join the mobs and run and panic and lose your mind? To be honest, nobody benefits from this. Nobody. So Gobbler, that the equivalent of the guy at home streaming the movie, that would be the guy that's not actively in the market. So that's somebody who's buying real estate, somebody who's buying crypto, somebody who's buying real world assets, appreciating real world assets, right? That would be somebody who's not at the theater and is streaming it live from home. They're not in the market right now. So seeing the market doing what it's doing, they're sitting at home going, wow, sure, I'm glad that I stream movies from home. Check out ZOM. Okay. So guys, since we were starting here, right? I told you guys, Zemedica's killing me. It's down so much. My whole portfolio is obliterated. 175. Like, I'm pretty new to the market, guys. I've been at this a year and a bit, year and a couple of months, right? This is not new. This is why, guys, I recommend that you go and you read some good books, that you understand market history and financial history and the way that markets move and the way that people react collectively as a group of people, and understand that this too will pass, right? Well, that's a great idea. Step away from your dashboard, right? Oh, it's a bull run. Everybody back in, right? So now everybody that ran from the door, somebody just, let's go back to the picture, right? Backdoor picture. Somebody goes, false alarm. It's not a fire, it's a flashlight. And now everybody tries to run back into their chairs and get back to their seats that they had. And what they realize is that a handful of guys like Millennial are chilling here. And Martini's gone home to watch the movie anyway, so she doesn't care because she's getting Whataburger on the way home, right? Like, these people don't care. These people that got out of the movie theater, they don't care. They'll just go see another movie. And this person doesn't care. But the people that are left trampled on the ground here, they're going to care. Where would Stocky be? That's not fair, but Stocky for some reason is the guy that is, yeah, he'd be the guy like the attendant at the theater who's standing here telling people, much like I am, please move calmly to the exits while we address the fire. This is the reason why there's a fire, and these are the plays that you can make. Please purchase popcorn and soda. He's the usher. Yeah, I would say he's probably the usher. Um, as am I. I mean, right now I'm saying that financially my portfolio is this, but being here on stream with you guys, this is financial streamers right now. Telling everybody to calmly move to the exits or understand what is happening. This is streamers. This is me as a trader. This is me as a streamer. Please buy your shorts on your way out. Yeah. But the more calm and relaxed you guys can be on this, the better off you're going to be for sure. Okay. Therein is the paint lesson for the day, ladies and gentlemen. Bitcoin back up to 48,000. Okay. Crowd. We were going to look at CrowdStrike holdings. So for me, guys, I wouldn't trade CrowdStrike. Nice, man. Got that beer. CrowdStrike, guys, this is outside what I play. I play equity. This is obviously outside my price range given the size of my portfolio. So that's it. Is Jay Powell speaking now? He's supposed to be. CPAC Powell. Yeah, I already did it. It's going to be the same. It hasn't changed. CPAC. Powell. I want to watch Powell, but I don't want to watch it on. I can't watch it on a news channel. I have to watch it on. Um, on PSAC or PBS, C-SPAN. C-SPAN. Sort of blow out your eardrums there.
Bestows a sense of purpose. It improves mental health, increases lifespans, benefits workers and their families. Unquote from the chair. What that boils down to is the dignity of work. It means hard work should pay off no matter who you are, no matter what kind of work you do, whether you punch a clock or work for tips or work on a salary or taking care of aging parents. It means we need to start measuring success of our community by the success of the people who make our economy work. Chair Powell, thank you. I look forward to your testimony. Senator Toomey.
Yeah, I don't know why he's so
you,
close
Chairman,
to the damn
thank
computer.
You, Chairman Powell. Welcome back to the Banking Committee. I look forward
Hey, look at that! That guy gets it.
About a year ago, the U.S. economy was entering an unprecedented economic contraction as a result of the shutdowns that followed the spread of COVID-19. We all remember credit markets seizing up. Second quarter GDP last year fell by over 30%. Unemployment rate reached about 15% in April, the highest it had been since the 1930s. The economy was in very desperate straits, to say the least. Thankfully, the worries about a long, drawn-out depression appear to have been unfounded. In response to the economic collapse, Congress and the Fed took very, very bold, unprecedented, and decisive action. The Fed quickly lowered interest rates, launched a quantitative easing program on unprecedented scale, and helped facilitate market functioning through a variety of emergency programs that were funded through congressional legislation. And we in Congress passed over $4 trillion in relief over 5 overwhelmingly bipartisan bills. Fortunately, today, we are in nothing like the situation we were in last spring. Today, the unemployment rate is now 6.3%, about where it was in July of 2014. 18 states have unemployment rates below 5%. The average household in America is in a better financial position today than it was in before the pandemic. Personal savings rates are up by over $1.6 trillion. Consumer credit is down by over $100 billion. There's no question there are some subsets.
Who's buying that? The average American household is doing better now than they were before COVID.
Much harder than others.
Who's buying that narrative?
In the aggregate, the fact is Americans have more disposable income now than they had before the crisis. And yet, Congress is in deliberations to spend another $1.9 trillion with universal payments to people who've never had as much income as they do, to entities that have, such as state and local governments, which in the aggregate have taken in more revenue in 2020 than they did ever before. We are well past the point where our economy is collapsing. And in fact, our economy is growing very powerfully. The last thing we need is a massive multi-trillion-dollar universal spending bill. And we should recognize that all of this spending comes at a cost. It all gets funded with government debt, which is either monetized, which has its own dangers, or it's a burden that gets passed on to future generations that have to service that debt. In 2020, debt held by the public reached 100% of our total economic
Cut them all.
output,
that's exactly the problem.
CBO projects that over the next 10 years, net interest
quantitative spending is not the same as quantitative easing. Quantitative easing is in small amounts for a dedicated period of time. Quantitative spending is literally that, just endless spending for the sake of spending in order to
overheating in places that lead to unwanted inflation, and I think the data is
this K-shaped recovery, guys. The K-shaped recovery is killer, because what you're going to get is he's saying, well, the average looks good, right? Well, of course, the rich are getting richer and the poor are getting poorer, but the average still looks like it's staying the same. So you can say, oh, the average is actually getting better. Well, that's because the rich got significantly richer.
In the near term,
the poor can only get so poor, right? The rich can endlessly get richer.
$120 billion of securities per month, maintain short-term interest rates at basically zero, and Congress is considering, as I said, another enormous bill. And another matter, I want to make the point that I do think it's very important for the Fed to continue focused on the mandate it has and not to seek to broaden that mandate. As noble as the goals might be, issues such as climate change and racial inequality are simply not the purview of our central bank. So during this hearing, I look forward to hearing about Your views, Mr. Chairman, on the economy, on
I think he
monetary
makes a really good
policy,
point on that.
and the
The
state
Fed
of our
should
markets.
not be involving
And
itself
with that, I yield.
with matters of government policy in regards
Thank
to
you,
racial
Senator
equality
Toomey.
or
Today, we'll hear from Federal
environment.
Reserve Chair Jerome Powell, the Fed's monetary policy and the state of the U.S. economy. It's nearly 1 year since the coronavirus pandemic first wreaked havoc in our country. We know the Federal Reserve plays a key role in making sure that our economy recovers for all Americans. Chair Powell, thank you for your service. Thank you for being in front of our committee today and for your testimony. Proceed.
Thank you and good morning. Chairman Brown, Ranking Member Toomey, and other members of the committee, I'm pleased to present the Federal Reserve's semi-annual monetary policy report. At the Federal Reserve, we are strongly committed to achieving the monetary policy goals that Congress has given us: maximum employment and price stability. Since the beginning of the pandemic, we've taken forceful actions to provide support and stability, to ensure that the recovery will be as strong as possible, and to limit lasting damage to households, businesses, and communities. Today, I will review the current economic situation before turning to monetary policy. The path of the economy continues to depend significantly on the course of the virus and the measures undertaken to control its spread. The resurgence in COVID-19 cases, hospitalizations, and deaths in recent months is causing great hardship for millions of Americans and is weighing on economic activity and job creation. Following a sharp rebound in economic activity last summer, momentum slowed substantially, with the weakness concentrated in the sectors most adversely affected by the resurgence of the virus. In recent weeks, the number of new cases and hospitalizations has been falling, and ongoing vaccinations offer hope for a return to more normal conditions later this year. However, the economic recovery remains uneven and far from complete, and the path ahead is highly uncertain. Household spending on services remains low, especially in sectors that typically require people to gather closely, including leisure and hospitality. In contrast, household spending on goods picked up encouragingly in January after moderating late last year. The housing sector has more than fully recovered from the downturn, while business investment and manufacturing production have also picked up. The overall recovery in economic activity since last spring is due in part to unprecedented fiscal and monetary actions, which have provided essential support to many households, businesses, and communities. As with overall economic activity, the pace of improvement in the labor market has slowed. Over the 3 months ending in January, employment rose at an average monthly rate of only 29,000. Continued progress in many industries has been tempered by significant losses in industries such as leisure and hospitality, where the resurgence in the virus and increased social distancing have weighed further on activity. The unemployment rate remained elevated at 6.3% in January, and participation in the labor market is notably below pre-pandemic levels. Although there has been much progress in the labor market since the spring, millions of Americans remain out of work. As discussed in the February monetary policy report, the economic downturn has not fallen equally on all Americans, and those least able to shoulder the burden has been hardest hit. In particular, the high level of joblessness has been especially severe for lower wage workers and for African Americans, Hispanics, and other minority groups. The economic dislocation has upended many lives and created great uncertainty about the future. The pandemic has also left a significant imprint on inflation. Following large declines in the spring, consumer prices partially rebounded over the rest of last year. However, for some of the sectors that have been most adversely affected by the pandemic, prices remain particularly soft. Overall, on a 12-month basis, inflation remains below our 2% longer run objective. While we should not underestimate the challenges we currently face, developments point to an improved outlook for later this year. In particular, ongoing progress in vaccinations should help speed the return to normal activities. In the meantime, we should continue to follow the advice of health experts to observe social distancing measures and wear masks. I'll turn now to monetary policy. In the second half of the year, the Federal Open Market Committee completed our first ever public review of our monetary policy strategy, tools, and communication practices. We undertook this review because the U.S. economy has changed in ways that matter for monetary policy. The review's purpose was to identify improvements to our policy framework that could enhance our ability to achieve our maximum employment and price stability objectives. The review involved extensive outreach to a broad range of people and groups, including through a series of Fed Listens events. As described in the February Monetary Policy Report, in August, the committee unanimously adopted its revised statement on longer-run goals and monetary policy strategy. Our revised statement shares many features with its predecessor. For example, we have not changed our 2% longer-run inflation goal. However, we did make some key changes. Regarding our employment goal, we emphasized that maximum employment is a broad and inclusive goal. This change reflects our appreciation for the benefits of a strong labor market, particularly for low and moderate income communities. In addition, we state that our policy decisions will be informed by our assessments of shortfalls of employment from its maximum level, rather than by deviations from its maximum level. This change means that we will not tighten monetary policy solely in response to a strong labor market.
What's up?
Regarding our price stability goal, we state that we will seek to achieve inflation that averages 2% over time. This means that following periods when inflation has been running below 2%, appropriate monetary policy will likely aim to achieve inflation moderately above 2% for some time. With this change, we aim to keep longer-term inflation expectations well anchored at our 2% goal. Well-anchored inflation expectations enhance our ability to meet both our employment and inflation goals, particularly in the current low interest rate environment in which our main policy tool is likely to be more frequently constrained by the lower bound. We've implemented our new framework by forcefully deploying our policy tools. As noted in our January policy statement, we expect that it will be appropriate to maintain the current accommodative target range of the federal funds rate until labor market conditions have reached levels consistent with the committee's assessment of maximum employment, and inflation has risen to 2% and is on track to moderately exceed 2% for some time. In addition, we will continue to increase our holdings of Treasury securities and agency mortgage-backed securities, at least at their current pace, until substantial further progress has been made toward our goals. These purchases and the associated increase in the Federal Reserve's balance sheet have materially eased financial conditions and are providing substantial support to the economy. The economy is a long way from our employment and inflation goals, and it is likely to take some time for substantial further progress to be achieved. We will continue to clearly communicate our assessment of progress toward our goals well in advance of any change in the pace of purchases. Since the onset of the pandemic, the Federal Reserve has been taking actions to more directly support the flow of credit in the economy, deploying our emergency lending powers to an unprecedented extent, enabled in large part by financial backing and support from Congress and the Treasury. Although the CARES Act facilities are no longer open to new activity, our other facilities remain in place. We understand that our actions affect households, businesses, and communities across the country. Everything we do is in service to our public mission. We're committed to using our full range of tools to support the economy and to help ensure that the recovery from this difficult period will be as robust as possible. Thank you. I'm happy to take your questions.
Thank you, Chair Powell. First, just a yes or no question. Do you agree the most important thing we can do for the economy right now is get people vaccinated?
I would say that yes, that is the single best policy to return the economy to its potential growth.
Thank you. The researchers in Minneapolis Fed say the pandemic is forcing mothers of young children out of the workforce. Some 3 million women have been forced out of the paid labor market in the past year. Everyday families face impossible choices between their paychecks and caring for their children. The Biden Rescue Plan, as you know, provides the funding we need to get Americans vaccinated, as you suggest is the right policy. And that will help kids go back to school, to help working moms back to work, get back to work safely. What can the Fed do to make sure women, especially those with young children, can return to the workforce so that we don't end up with an even bigger lasting gender gap in the labor market?
So the tools that can really address specific groups, for example, women who've perhaps temporarily dropped out of the labor force, those are really fiscal policy tools. Obviously, those are not tools that we have. And I today will stay away from fiscal policy and really talk about what we can do.
That's not my job.
The main thing that we can do is continue to support
not my job.
The economy, give it the support that it needs. We're still 10 million jobs below the level of payroll jobs before the crisis. There's still a long way to go to full recovery, and we intend to keep our policy supportive of that recovery.
Thank you for acknowledging in your opening statement and your comments to many of us and for your public comments, frankly, about how much we need to do to fight racism and increase diversity. Yet we know historically the Fed's monetary policy has benefited wealthy savers and homeowners. Decades of discrimination in the financial system we talked about earlier, from redlining to the subprime mortgage crisis, specifically targeted Black, Brown, and other vulnerable communities. It's clear the Fed's policy and failure to regulate predatory actions in the banking sector have contributed to the racial wealth, income, and home ownership gaps. You've said that the Fed's tools can't address the underlying causes of racial injustice or income and wealth inequality in our economy. I think you give up a little too easily when you say that. So how can the Fed use its supervision authority to enforce anti-discrimination laws and fight racial injustice and income inequality?
That's not my job.
We do have responsibilities and authorities for fair lending, for example, under a number of statutes, and we take those responsibilities very seriously, and I think carry them out robustly, and that is an important part of our mandate, and so that is something that we can do, and I think we do aggressively. In addition, through our community and consumer affairs division, and through the Federal Reserve banks, we don't spend public resources, but we try to attract private resources around, for example, initiatives that will address issues of economic issues of low and moderate income communities and racial minorities.
I think we can do more, but we will discuss that later. Chair Powell, in the middle of the pandemic, bank regulators have loosened capital requirements at the biggest banks, and one of its changes to the capital rules, the Fed stated the rule was meant, and I quote, to allow banking organizations to expand their balance sheets as appropriate to continue to serve as financial intermediaries rather than to allow banking organizations to increase capital distributions, unquote. In other words, the Fed reduced capital standards so banks would lend more, not so they would pay dividends. But it's, as you know, it's not what's happening. The biggest banks have gotten larger, they've gotten more profitable, but they haven't increased lending. Dividends, however, have remained steady. My question is, Mr. Chair, will you promise to the committee that you will not extend any exemptions for capital requirements for banks and bank holding companies that have continued to pay dividends rather than invest in the real economy?
So we're talking here really about the temporary measures we took with respect to the supplemental leverage ratio, and those expire at the end of March. We have not decided what to do there yet, and we're actually looking into that right now. I'm not going to commit to connecting that decision to the payment of dividends as a separate matter. As you know, we intervened to require the banks to limit their dividend growth to zero, and also to limit their share buybacks. And the result, what you see now, is a banking system that has higher capital than it did going into the pandemic, and particularly for the largest banks, and one where the banks have taken very large reserves against.
I know it's not
losses,
like super exciting NFL on Sunday, boys, but this is required learning.
Perhaps, but I also we also understand that they have not been supporting the real economy to the degree that we hope they would, and we will continue that conversation. And I will send a written question to you on climate that we wanted to talk about. Senator Toomey.
Thank you, Mr. Chairman. Just on this topic, let me just state, I certainly hope that to the extent that banks have adequate capital for the circumstances that they face at any point in time, any capital beyond that should absolutely be available to be returned to the people who own those banks in the form of dividends or stock buybacks or whatever mechanism is suitable. And anything to the contrary is a terrible constraint on our economy and on economic freedom. I also want to just observe briefly, and I'm not asking for a comment on this, Chairman Powell, but if I could summarize and characterize your opening comments about the economy, I think it's fair to say that we have many areas, sectors of our economy that are performing extremely well, housing and the goods sector I think you referred to. And then we have very concentrated problems in certain relatively narrow sectors like hospitality and travel and entertainment, which are extremely depressed because of the circumstances. I think that clearly makes a very strong case that if there were to be further fiscal policy, it should address where the problem is and not where the problem is not. But to address monetary policy for a moment or so, I think the Fed's current forecast for growth for this year is over 4%. I think the consensus is well over 5%, with some thinking it could be considerably higher than that. The unemployment rate is now at 6.3, which is about where it was in 2014 when we were not contemplating multi-trillion-dollar bills. And I don't think we were buying $120 billion worth of securities per month. My concern is that the last two recessions were, I think, caused by asset bubbles that burst. 2001, it was the stock market. 2008, it was the mortgage credit market. In both cases, in my view, monetary policy contributed a great deal to the formation of those bubbles. The Dallas Fed president, Robert Kaplan, recently acknowledged that there's a link between the record amount of liquidity being pushed into the system and these unprecedented asset valuations that we're seeing in a whole range of assets, be it GameStop or Bitcoin or real estate, commodities. Across the board, we're seeing quite elevated asset prices and signs of emerging inflation. So I guess my question is, do you believe that there is a link between the liquidity that the Fed has been providing and some of these unprecedented asset prices?
So there's certainly a link. I would say, though, that if you look at what the market is looking at, what markets are looking at, it's a reopening economy with vaccination, it's fiscal stimulus, it's highly accommodative monetary policy, it's savings accumulated on people's balance sheets, it's the expectations of much higher corporate profits, which matters a lot for the equity market. So there are many factors that are contributing to to what's happening in markets right now. Monetary policy, I would certainly agree, is one of them.
Yeah, I would just suggest that, right, I agree. All of those things are happening. All of those indicators of growth and increasingly indicators of rising inflation. As you know, the TIPS 10-year break even on inflation is now over 2%, up from 0.6%. My point is that at some point,
forget your point. What's your question,
we've got too much liquidity going into the system. The economy is recovering very, very well. Problems are isolated and should be addressed narrowly. And I hope that $120 billion a month of bond buying doesn't become a permanent situation. One of the things I'm concerned about, I wonder if you could comment on, the risk that we would have an increase in inflation, an increase in bond yields that would correspond to that, but without being back at full employment. What would that imply? Which I think is a very plausible scenario for later this year. What does that imply for
no, he's not babbling.
The bond buying program?
That's a real question there.
So what we said about the bond buying program is that it will continue at the current pace, at least at the current pace, until we make substantial further progress toward our goals. And we've also said that as we monitor that progress,
given the unemployment rate and continued bond purchasing, what is the effect on the market and inflation moving forward into future quarters?
So that's what it will take for us to begin to moderate the level of purchases. It's substantial further progress toward our goals, which we haven't really been making for the last 3 months, but expectations are
Cobbler, that was pre-Powell,
as the pandemic subsides.
Well, thank you, Mr. Chairman. I would just suggest that there are a lot of warning signs that have not been worrisome in the past, but now are certainly blinking yellow. And with that, I will yield.
Thank you, Senator Menendez.
Thank you, Mr. Chairman. Chairman Powell, at the end of this pandemic, we need to ensure that we have a more equal society. Unfortunately, we're not on a path to an equal recovery. As of January, the Black unemployment rate is 9.2%. The Hispanic unemployment rate is 8.6% compared to 5.7% for white workers. According to the New York Fed, over the course of the pandemic, the black labor force exit rate has increased dramatically, while the white labor
Powell started
force
talking
exit
at
rate
10.
has returned
9:45 was just before his talk.
levels. Doesn't this mean that the Black unemployment rate is likely misleadingly low compared to the white rate?
Well, this, as you point out, this pandemic was particularly bad for these long-standing disparities that we have in our economy. The job losses were heavily concentrated in public-facing service sector jobs. Those tend to be more skewed towards lower-paid and in many cases minorities and women. And so that's really where the big pockets of unemployment were made. And so, and you're right. So the burden really has fallen more in the low and moderate income communities than would typically be the case. It's always the case to some extent. This particular event, though, is very somehow precisely aimed at those people, and we're well aware of that.
Well, I appreciate that acknowledgement. We know from the Bureau of Labor Statistics that over the course of 2020, the labor force participation rate for Black men and women fell nearly twice as much as it did for white men and women. So you agree that minority families are bearing the brunt of the damage caused by the pandemic?
Yes, along with others at the lower end of the income spectrum, bottom quartile.
Would you agree then that addressing this disproportionate damage needs to be a central priority in relief efforts?
That's a fiscal policy question.
Yeah, so would I. Now, as part of the Federal Reserve's mission to ensure maximum employment, what's the Federal Reserve's plan for maximizing employment for low-income and minority workers?
So we look, when we say that maximum employment
Not
is a broad and
reparations,
inclusive goal,
no.
that means we look not just at the headline numbers, we also look at different groups, and we try to take all of that into account in making our assessment. So we will take into account the headline numbers, but also those for other groups as we think about reaching maximum employment.
Well, I hope that in your mission that the Federal Reserve looks at this, because a Federal Reserve study showed that while high-income jobs mostly recovered to pre-pandemic levels, unemployment among low-wage workers remains 14% below pre-pandemic levels. And this is in spite of the fact that almost half of all low-wage workers are essential workers, the people who actually let us stay home when we were told stay home to avoid the spread of the pandemic and to be infected, but they were risking their lives in the jobs that they did. And so I believe we have the tools and what we to try to make this an equitable recovery. So would you commit to working with Congress and the Treasury to help low-wage workers and minority workers be able to recover just as strongly as others?
We will do that. I will say, though, that monetary policy as a tool is famously it's a broadly effective tool. It doesn't enable us to target particular groups. It lifts the entire economy. But we're going to be mindful, though, of the disparities that exist as we make our decisions.
Then finally, as of February 1st, an estimated 13 million adults were not caught up on their rent. Another 10 million adults were not caught up on their mortgage payments. Our country is very clearly in the midst of a housing crisis. What would be the effect on the housing market and our overall economy if Congress doesn't provide additional resources to help families struggling to pay their rent and mortgages?
Well, if those people, if it were to get to the point at which people were evicted, then you're talking about people's lives being disrupted in ways that are sometimes quite hard to recover from, both for renters and owners. So it is important. I think the single best thing we can do about that, of course, is to keep monetary policy accommodative, to do what we can to speed the recovery so that it will be robust and complete as soon as possible.
Well, losing millions of people losing their homes would it not only affect rateable basis and the most single aspect of wealth. So I hope you'll keep your eye on that. Thank you, Mr. Chairman.
Not my job. That was just not my job. I have nothing to do with people losing their mortgages and homes. That completely outside my purview.
Chairman Powell, thank you for your service of a number of years and how you, I believe, done an outstanding job as chairman of the Federal Reserve. I would like to associate myself this morning with a lot of the questions that have been asked already by Senator Toomey, the concern of inflation, the concern of the balance sheet, where's the economy going when we get over this COVID, which we all hope and pray will be sooner than later. And I'd like to add to that, Mr. Chairman, what's your view of the world economy tying into ours, because it's an important factor as we go forward, assuming in the next, say, 6 months that we get a handle around COVID in the country, and Europe, for example, does the same thing.
So I'll take those one at a time. On inflation, let me say that we do expect that as the couple of things. One, first, as the very low readings of last March and April,
let's see, stimulus, anything that's tied directly to the stimulus would be number one, because that's coming first, and then legalization would be number two.
That'll be a temporary effect, and it won't really signal anything. More importantly, though, with all the factors we've been discussing, you could see spending pick up pretty substantially in the second half of the year. And that would be a good thing, of course, but it could also put upward pressure on prices. And I would just say that essentially it doesn't seem likely that that would result in very large increases or that they would be persistent. We've all been living in a world for a quarter of a century and more where all of the pressures were disinflationary, pushing downward on inflation. We've averaged less than 2% inflation for more than the last 25 years. Inflation dynamics do change over time, but they don't change on a dime. And so we don't really see how a burst of fiscal support or spending that doesn't last for many years would actually change those inflation dynamics. I will also say there's forecasters need to be humble and have a great deal to be humble about, frankly. But so if it does turn out that unwanted inflation pressures arise and they're persistent, then we have the tools to deal with that, and we will. Shall I continue? So on the balance sheet, we're going to continue we're at a stage where with 10 million people,
market likes that.
Payroll employment is 10 million below where it was before the pandemic. We're a long way from maximum employment. We're going to keep the balance sheet's going to continue to provide the support that we think the economy needs. Over time, the growth of it will slow, but that decision is the one that we talked about earlier, where asset purchases will continue until we make significant further progress toward our goals. You ask about the U.S. economy and the world economy. I do think, and many forecasters agree, that once we get this pandemic under control, we could be getting through this much more quickly than we had feared. And that would be terrific, but it's not done yet. The job is not done. That's the thing I keep coming back to, is we've got to finish the job with the pandemic, get it under control so that the U.S. economy can really reopen. Other countries around the world have the same set of issues. But there is, people will get vaccinated and we can get the disease under control properly. The second half of this year and thereafter, the economy could be very good, and could be good elsewhere in the world as well.
Has the fact that the savings rate has gone up tremendously in America, does that bode well in the future as far as perhaps economic?
Since Powell started talking, my portfolio's recovered $5 grand.
Just is that people have not been able to spend. They haven't been able to travel, go to restaurants, and that. So it's kind of forced savings in a way. So they'll spend some of that going forward. You're really thinking, I think, about the fact that the U.S. needs more savings so that it'll have more investment and more productivity. It would be nice if we had a higher savings rate, and it would be also nice if we didn't have a lot of dis-savings at the federal level. That's a lot of it is that these budget deficits require a lot of assets. Not that that's something we need to turn to again, but I think this is not the time to be thinking about that. But that time will certainly come.
Thank you, sir.
Thank you. Thank you, Senator.
Thank you, Senator Shelby. Senator Tester.
Yeah, thank you, Mr. Chairman. And I want to start by thanking Chairman Powell. I very much appreciate your frankness. I very much appreciate.
Remember, ladies and gents, anybody that sold this morning on that dip, they got trampled at the door.
over the past number of years, but you've stepped up. You certainly don't want a bunch of politicians determine monetary policy. And so I'm glad you're at the helm. I also think that
That might have been your entry
over
for.
this $1.9 trillion
Oh, actually, no, you don't have any free
package,
capital, do you? For
in front of
CIM?
you on probably every damn
Untitled.
committee that I'm on, and a bunch of others. Some of that is, well, all of it is necessary.
No, it's the current adoption
but-
rates,
but I do
Louisiana,
wanna
is
talk
about,
to you
and I'm
because,
being generous when I say
everybody
10%
makes
of the
points that
population.
I
So
go, yeah,
1
that's
out
a
of 10
good
people
point.
looking to purchase a vehicle would
And
consider
it's
an
true,
EV.
housing.
Meanwhile,
the
we have an
housing market
abundance
in a place like
of
Montana is hotter than
electric
hot.
vehicles
It
flooding
is
into the
quite
market
frankly
from
booming, and
every
there's another
distributor.
problem we're gonna, I
So
want to
when
talk to you a little
supply
bit about
outweighs
the
demand,
housing thing. But there are other
you've got a big
industries, and there
problem.
are folks out there who, quite frankly, don't have the job they used to have and may never get that job back. And there are business people out there that are up against it. Some of those businesses will go broke and never reopen. Others will. I just kind of want to get your perspective on, if you were not the head of the Fed, but in the United States Senate, where would you pay most of your attention to? And because I agree, any money we spend needs to be focused where it'll do the most good. There's no doubt about that. Where is your focus? Where would your focus be? Would it be unemployment? Would it be hospitality businesses, or would it be something more global than that?
It's an interesting question. Again, maybe the grass is always greener, but so our work really relates to managing the business cycle in a way. But what I always think I would focus on is more what we call the supply side, which is really investing in things that will increase the potential growth rate of the United States economy over time and make that prosperity as broadly spread as possible. Now, so let me be more specific. It amounts to investing in people, and that means education, it means training, it means all those things. And that enables those people to take part fully in our great economy. And I really do think in a global economy, people who are able to use and benefit from technology, there's no limit on the amount of those people who can be working in the United States, because it's such a global economy. I also think it's important for businesses as well, that they have a climate where they can trust, that inflation is going to be under control and that business conditions are going to be good, and that they can invest in. And I think the federal government investing in basic science over time has produced a lot of productivity enhancing things. But more generally, Senator, I think focusing on things that will make a longer run difference to our economy is what I would do.
Okay, appreciate that. Now I want to go to housing, because I don't, I talk about Montana, but I think this is true all over. We don't have enough affordable housing. We don't have enough workforce housing. I think that short-term and long-term, by the way, this is going to be a drag on the economy. Do you see the Fed playing any role, or do you think they could have a role in
Smellman, not my job coming up.
the amount of affordable housing that's out there? And if you do think the Fed plays a role, what would that role be?
I don't really think we do. When it comes to
Not my
set of
job.
policies like that, that's targeting, the fiscal power of the federal government to what is seen as a worthy cause. It's not really something.
Zomedica just went green on the day for a moment.
Housing
It touched
discrimination and things like that in lending, but I don't think we are in a position of being able to allocate credit to worthy beneficiaries. That's really fiscal policy.
Okay, getting back to the pandemic. You've implemented a lot of monetary tools during this crisis. In your opinion, have they been sufficient? And if they have, that's the first question. Have they been sufficient?
Yes.
I think they have. I think the difference really this time is that fiscal policy has really come to the table. It's made a big difference.
Moving forward, have you looked at any changes to that, to the policies, the monetary policy tools that you've used? Moving forward.
Not yet. I mean, we're looking into that. Of course, we'll do. Right now, our focus is on providing.
It's not tough, guys. It's really not hard to get this.
Turning to an evaluation of everything.
Okay, I'm going to keep going. I'm going to keep telling you what Powell's answer is going to be before we get to
it. Thank you, Mr. Chairman. Thank you, Chairman Powell.
Thank you, Senator.
Thank you, Senator Tester. Senator Scott.
Thank you, Chairman Brown, and thank you, Chair Powell, for being here with us this morning. Certainly an important time for us to engage in the conversation about the future of employment in our nation, and one of the core responsibilities of the Fed, of course, has to do with unemployment. There seems to be so few issues right now, Chairman Powell, that actually unites the left and the right. I'm always stunned in Washington when we find something that unites both sides, and frankly, the minimum wage issue is an issue that has united both Republicans and Democrats on opposing having the $15 minimum wage as a part of the COVID-19 relief package. It's
not my job.
Good to see my friends on the left coming to the conclusion that in the middle of a pandemic that, according to the Congressional Budget Office, has already shuttered, the $15 minimum wage would shutter another 1.4 million jobs. Their earlier estimate went as high as 3.7 million jobs in the middle of a pandemic that has eliminated 10.7 million jobs. This seems to be common sense from my perspective, from the perspective of Democrats and the Congressional Budget Office. My question for you, sir, is has the Fed economists conducted research on the potential impacts of raising the minimum wage to $15 an hour?
I don't know that we've looked at that question particularly. We have great labor economists who've done a lot of work on the broad area.
Yes, sir. Are there conclusions similar to the conclusions of the Congressional Budget Office as it relates to the negative impact of raising the minimum wage during the pandemic?
Let me say, as I must, that this is a classic issue that the Fed never takes a position on, and I'm not going to take a position on it here today. It's fiscal policy. Most of the reresearch still says that there's some trade-off between job loss and those whose wages go up. But actually, the sort of unanimity of that finding of 30 or 40 years ago is no longer in place. There's a much more nuanced understanding of it. But in any case, it's just an issue where we don't play a role or express a view. But I can share with you the research that we've done. Be happy to do that.
That would be
that our staff has done.
That would be very important, especially as you think of the Fed's responsibility as it relates to providing a sustainable economy that includes keeping unemployment.
Yeah, so they don't actually want an answer. They're trying to push their agenda forward. So keep that in mind. Like they're playing push the agenda
of the minimum wage that is obviously, according to the Congressional Budget Office, going to eliminate the minimum of 1.4 million jobs. I think is an important engagement from the Fed on that issue. I'll ask you a different question as it relates to
part of their purview.
COVID relief package of $1.9 trillion. It seems to me that over the last fiscal year, we spent right around $6.5 trillion addressing the pandemic. My question for you is, as we see another $1.9 trillion on top of the 6.5 that we've already spent, what is the impact on the issue of rising inflation in excess of the Fed's longer run objective of 2%?
He's already answered this.
So, of course,
we can't determine what the rate of inflation will be, and we might change it.
On the proposal.
Not my job, paired with
the fiscal package
we'll adapt as we
go.
go.
Not our role. I will say on inflation, there perhaps once was a strong connection between budget deficits and inflation. There really hasn't been lately. That doesn't mean it won't return. But again, my expectation will be that inflation will probably be a bit volatile over the next year or so, due in a significant amount to particular things to do with the pandemic. For example, we'll see a slight increase in inflation in a few months because of the base effects that I mentioned. We'll also see, perhaps, we don't know this, but we may see upward pressure on prices as the economy fully reopens. A good problem to have. I don't think that those effects should either be large or persistent. And the real reason for that is that we've had decades of well-anchored inflation expectations, meaning that we've had a very volatile economy for the last 15 years. And inflation has just kind of done what it was going to do. It didn't go up.
Thank you very much, sir. I appreciate your your answer, the fact that you're unwilling and unable to answer the questions as it relates to the minimum wage, and certainly you don't want to get into the politics of the $1.9 trillion package. I don't blame you. If I were you, I wouldn't want to get into the politics of it at all, frankly. And I certainly understand your reticence to do so. I'll use my few seconds here to simply say that Congressional Budget Office, some Democrats, all Republicans, all agree that raising the minimum wage is a way to destroy jobs in an economy that is looking.
So this is this guy's opinion. I agree with that opinion, but it is his opinion. There's no data or facts, and it has nothing to do with fiscal policy from, or it has nothing to do with monetary policy from Powell.
Good work you're doing. I think in response to Senator Tester's questions, when you were talking about the kind of investments we ought to be making that are long-term, particularly as we're thinking about infrastructure, one of the areas, and understanding what my friend Senator Scott just said in your answer, that you don't want to weigh in on the president's most recent plan, I would like you, though, to comment whether you believe that broadband investments fall into that category of kind of long-term structural change we need. I would argue over the last 11 months we've seen that broadband is a necessity. I think it is absolutely COVID related. I hope that the current package can be changed to actually include a sizable investment in broadband. As good as our 4 packages, bipartisan packages, have been to date, the broadband investment has been meager or non-existent.
This has nothing to do with anything that Biden does, so not my job.
Somewhere in the $40 to $50 billion range, we get about 97% coverage, along with better affordability.
You're asking about internet coverage?
Do you agree that
Come on.
efforts to close the broadband gap not only represent long-term investments, but also have some direct relationship to the current healthcare crisis?
So, as you and I have discussed on a number of occasions, I would agree that broadband is kind of a classic 21st century infrastructure, and one of those things that can support growth. But I of course, don't want to go anywhere near the question of what should be included in the package. If that's okay.
What about the question, though, from a macroeconomic standpoint, broadband and trying to close the digital divide, if we're going to have a fulsome recovery across all socioeconomic groups, could you speak to the question of the necessity for broadband to be ubiquitous if we're going to have that kind of robust recovery, and comments about whether broadband is at this point, a nice to have or an economic necessity, whether it's telework, telehealth, or teleeducation?
No, so again, as you and I have discussed on a number of occasions,
not my job.
I would agree that it is a classic piece of infrastructure for the modern economy, for the service economy, for the technologically advanced economy, and having it broadly available just could mean as broadly available as possible could be a significant benefit economically.
If not broadly available, are we going to be able to see the kind of broad-based recovery that I think we're all looking for?
Well, I think we have
That's not my job.
We have a bunch of issues to deal with that relate to these persistent disparities that we see to do with education and training and all those things. But that would certainly be one of those things.
Senator Scott, in his previous line of questioning, raised the inflation issues, and I know we've seen...
Harry, you can't compare Denmark to the U.S. That's like comparing a tugboat to the Titanic.
About a 41 basis point increase on some of our 10-year benchmarks. It's still relatively small. I tend to agree. I think we do need to make a sizable investment right now. I'm not sure the inflation risks, I agree with you, are not as high as potentially might be. Could you just briefly give some of the tools you've got available as Federal Reserve Chair if you started to see inflation rise at a level that you didn't feel comfortable with?
Well, those are the classic tools that we have. Again, I really do not expect that we'll be in a situation where inflation rises to troubling levels. At this point, the committee, Federal Market Committee, is seeking inflation running moderately above 2% for some time. So the real question is, as we go through this, are we going to find ourselves in a situation where inflation expectations are de-anchored and inflation is moving up and is persistent? And I think we're all very, acquainted with the history of how we got into that situation in the 1970s. We did that in the 1960s, and we have no intention of repeating that. So central banks and the Fed learned how to keep the centrality of keeping inflation under control. We know how to do that. And that's just by not allowing the economy to just ignore constraints over time. But I think this is not a problem for this.
So you guys see the SPY recovery so far?
As near as I
glad
can
you
figure,
stayed in your seats in the movie theater.
Then we do have the tools we need.
We're down to
I just left and made breakfast and came back.
But let me just, if you want to make some general comments, I mean, I would argue that the pandemic was the first major real world stress test we've had on our fiscal system since 2000.
One of my friends messaged me. He's just like, "Oh my God, do you see what's going on?" I was like, I just went to go make breakfast and I came back. I don't know what you're talking about. I saw what's happened. I was like, I don't have any capital to put in this. I left.
Well, I think the large financial institutions that are at the heart of our financial system proved resilient. They did.
I'm working still, sweetie.
They've been able to keep lending, and their capital levels have actually gone up.
Go tell mommy I'm
during this period. As I mentioned, their liquidity levels are at highs. So I think that the work that we did over the course of the last decade and some has held up pretty well so far, and I expect it'll continue to.
Thank you, Mr. Chairman. Thank you, Chairman Powell.
Thank you, Senator Warner. Senator Rounds of South Dakota.
Thank you so much for the follow, guys. Much appreciated.
Chairman Powell, first of all, it's good to see you again, and appreciate your service to our country as well. Thanks for being with us today. I'd first like to ask about the SLR exclusion, which is set to expire on March 31st. My colleagues have mentioned it earlier, but did not really get into the heart of the matter. The temporary patch allowed banks to exclude ultra-safe assets, U.S. Treasuries and deposits at the Fed, from their balance sheets. This was important in preserving bank liquidity during last spring's flight to cash, and was common sense move since the Fed can't go bankrupt and the Treasury has never failed to meet its obligations. We all agree that the economy is still in need of fiscal and monetary support. The chairman himself said that banks should be doing more to help their workers and our broader society, but they can't do that when we're tying their hands with excessive and challenging capital requirements. It would appear Congress is going to create even more bottlenecks in our financial plumbing by flooding the economy with about $1.9 trillion in new money that banks will have to hold capital against as soon as the Treasury starts writing the checks. My question is, would you agree that it makes sense to seriously consider extending the SLR exclusion, given the other measures the Fed and Congress are taking to facilitate our economy's recovery?
So I do think that the SLR exclusion, I know that it expires at the end of March, and we actually haven't made a decision on what to do. It's something we're in the middle of thinking about right now. And so I'm just going to have to say that we'll be making a decision and announcing that pretty soon here.
I think the reason for my question is that I think last time around and in the past, we've had challenges with banks that have come in and said, look, we've got folks that want to bring their assets in. They've got to have a place to put it. It is liquid. It's what we're going to have. Most certainly that has impacted our ability and the reason for the SLR in the first place. And it just seems to reason that as you talk about it and as you continue to discuss it, I hope that we really do keep an open mind, and I presume you are keeping an open mind on the need for that, as this amount apparently will be put into the economy in very short order. And so I simply bring it up as saying I think there's a lot of us that think that that's going to be an important part of the discussion to have. Let me lead into another question with you, sir. We've been monitoring the increase in Treasury yields from about 0.9% at the start of 2021 to approximately 1.37% when the market closed yesterday. I understand that this reflects a view of an improving economy, but also comes with increased borrowing costs, increased inflation, and potentially a move by the Fed to increase interest rates down the line. How do you view the increase in Treasury yields in the broader context of our economy at this point?
You can actually talk about that.
So first, we look at a broad range of financial conditions, and that's one. It's an important one, but really we look at the whole range of financial conditions, and it's very important to ask, why are rates moving up? And so if you look at why they're moving up, it's to do with expectations of a return to more normal levels, more mandate consistent levels of inflation, higher growth, an opening economy. In a way, it's a statement of confidence on the part of markets that we will have a robust and ultimately complete recovery. So those are the reasons that are behind that move, I would say.
Great. Well, look, thanks. We follow the markets. We follow on a regular basis whether the markets are moving up, they're moving down, and so forth. And I think in anticipation of what your thoughts were going to be today, I think the market was rather volatile. I'm just curious, when you walk into an opportunity like this where you're sharing your thoughts, I know that you want to be very careful in terms of the message that you send, and I think you do a very good job of being very careful in the way that you send the message. But let me just ask, in your opinion, when you prepare for this type of a discussion, knowing the markets are literally watching everything you say, what's the message that you'd like to send? Are you talking, we're going to have stability, it's going to be steady as she goes, we don't see changes coming up with regard to the availability of capital, we don't see changes that are going to impact inflation?
This is a great question.
What's the message that you really want to send as you share with us today and you're expected to be in front of our committees?
So I guess I'll say a couple things. First, the starting point is that we're 10 million jobs below where we were in February of 2020, 10 million payroll jobs. So there's a long way to go, and many of those jobs are concentrated in the lower end of the income spectrum, as I mentioned. Many parts of the economy have recovered, but in the bottom quartile, the unemployment rate is probably in excess of 20%, we think. So there's a long way to go. And monetary policy is accommodative, and it needs to continue to be accommodative. We've put forward guidance out both on our asset purchases and our rates. We think that forward guidance is appropriate.
But you need to pass the stimulus.
You can expect us to move patiently over time as we see better data coming in. You know, right now we've had 3 months of 29,000 jobs a month. It's not very much progress. We expect that such progress, which we had earlier last year, we had very fast progress. We expect that that'll begin to return in coming months, and expect us to move carefully and patiently and with a lot of advance warning.
Thank you, Mr. Chairman. Thank you, Mr. Chairman. I apologize for going over on my time.
Thank you, Senator Brown. Senator Warren of Massachusetts.
Thank you, Mr. Chairman. So our economy is suffering through a K-shaped recovery where the wealthy are doing better and better while working people are doing worse and worse. And
hold on.
Chair Powell,
not my job. Not my job. Not my job. That's her time.
Over the past few years, you've noted, I think I've got a quote here from you, that it's been a growing issue in our country and in our economy for 4 decades. You've talked a lot about how inequality undermines opportunity and mobility, and you've described it as something that holds our economy back. So I take it from these comments that you believe that inequality weighs our economy down and stunts economic growth. Is that a fair statement?
Yes, it is.
Good, and I agree with you on this. And the Fed's own data spell out the problem. I think you were just talking about it. You know, the top 1% of families last year received 20% of all the income in this country. And you think that's not good for our economic growth overall. Is that fair?
Well, I would say that the stagnation of incomes in the lower income area, and also the low mobility that we've seen emerge, those to me are the two most important things that I focus on when I talk about inequality.
Right.
Just stagnation of incomes and low mobility.
So not that the rich have money.
We're talking about
it's that the poor aren't.
Inequality, how much people earn each year to be able to pay the rent and to be able to put food on the table. But inequality also shows up in wealth, which is what families build over time. Money in the bank, home, stock. Wealth inequality is even more extreme in our nation than income
He doesn't address
inequality.
wealth inequality. That has
While
nothing
the
to do with
top
it. That's the free
1%
market, not my
families,
job.
this tiny slice, got 20% of all the income earned in the US last year. The top 1% held 33% of the total wealth in this nation. And now this pandemic is making inequality worse. Unemployment, as you just noted, is now at about 20% for the bottom quartile in this country, meaning that there are a lot of folks out there who are making choices about keeping the heat on or putting food on the table. Meanwhile, the wealth of America's 660 billionaires increased by $1.1 trillion over this past year. Inequality is felt in
That's
another
good for
way.
the
It's felt in
economy,
how people
lady.
pay taxes. The 99% in America pay, on average, about 7.2% of their total wealth in taxes in a given year. But the top 1/10 pay only about 3.2%. That's less than half as much.
Not my job.
Chair Powell,
Not my
does
job.
it
Taxation
increase
of
inequality
assets
where
is
the
not
wealthiest
his job.
Americans pay total taxes at less than half the rate of nearly all other American families?
Not my job.
These are you're getting farther and farther from the the kinds of inequality that we focus on, and frankly, the ones that we can do anything about with our tools. We can't affect wealth inequality certainly in the short term. We can affect indirectly income inequality by doing what we can to support job creation at the lower end of the market. So I leave to you. Those are really fiscal policy issues that I wouldn't. I can't really link those to our mandate. That's all.
I appreciate that you're trying to move sideways on this, but you have
It's not
pointed
sideways.
out that inequality is a problem in our country, that it holds back mobility, that it holds back opportunity. And I'm simply pointing out that inequality is felt not just in income, it's also felt in wealth even more so.
And that's your job to fix, you nut
our
job.
Tax structure makes that inequality worse over time. You know, extreme wealth inequality undermines our economy, as you have said. It undermines justice. It undermines our democracy. And our tax
That's not what he said, by the way.
focuses
He didn't say
almost
wealth inequality
entirely on
undermines the economy.
income
What he
and
said
lets
was
most of the wealth that the ultra-rich
the fact that
families have
the
accumulated
poorest people are
just
not
slip
gaining
right on
access
through.
to income
That just seems
is
to
the
me
problem, not that the
right.
wealth are wealthy.
You know, it's time for a wealth tax in America, a 2-cent tax on fortunes worth more than $50 million. If your fortune's over $1 billion,
that's your job then, lady. Why are you talking to Powell about it? That's your job. That's not his job.
That you have been very worried about as chair of the Federal Reserve. It's how we have a chance to level the playing field and build an economy that works for everyone. So thank you for being here, Mr. Chairman, and thank you, Chairman Brown.
Bye.
Thank you, Senator Warren. Senator Tillis of North Carolina. If not, Senator Kennedy of Louisiana.
Yes, sir. Can you hear me, Mr. Chairman?
I can, Senator. You got two Mr. Chairmans here.
Yes, sir. Mr. Chairman, the witness, what was our fourth quarter GDP growth?
Don't have. I'm reluctant to guess, but it was in the. I want to say 4%.
Right. That's what my numbers show too. What are you and your economists estimating that our GDP growth will be for 2021?
So we'll be updating our forecast. The last forecast we did the last forecast the staff did was in January. My guess is that the data have been a little more positive, but it'll be a good number. We'd be in the range that you see in the public forecast.
How about 6%?
Could be in that range, sort of 5 to 7.
At what point in 2021 will GDP, the level of GDP, equal pre-pandemic levels?
Sometime during the year. It depends on the growth rate. Could be second half of the year.
How about the end of January, or the end of February rather?
I don't know that. You know, it's you asked the question.
You're asking me to look into the future. I don't know. Sure.
The pre-pandemic level. If you froze the GDP, the economy in February a year ago, at what point would we be back to where we were February a year ago?
In the first half of the year.
Yeah, I mean, I see a lot of economists saying at the end of February. Do you disagree with that?
I can't agree with it because I don't know.
I was answering the question about the pre-crisis trend, which is what we're trying to affect.
Well, here's where what I'm getting at. You have strongly encouraged Congress to pass another coronavirus bill, $2 trillion. And I guess tell me, if you could, in just a couple of sentences, why you think we need to do that. If we're looking at 6% GDP growth this year, and
no, that's a good question. That's a valid question.
We'll be back where we were in February 2020.
If we're back to where we were pre-COVID, why do we need another
consistently
stimulus?
Not taken a position on this bill.
So you don't have an opinion about whether we ought to pass President Biden's bill?
As I've said since the December press conference, I think on every public occasion when I've been asked about it, I've said that it's not appropriate for the Fed to be playing a role in these fiscal discussions about particular.
There's not my job.
Particular provisions and particular
There's
laws.
It's just
we didn't comment on the Tax Cuts and Jobs Act. We didn't comment on the CARES Act. We just it's not our role to do that.
So your opinion is if we don't pass the bill, you're cool with that?
Well, that would be expressing an opinion. So that's what I'm not doing is expressing an opinion.
Well, would you be uncool with that?
That would also be expressing an
by
opinion.
Being either cool or uncool, I would have to be expressing an opinion.
Okay. How do you think we ought to pay all this money back that we're going to borrow and that we already have borrowed?
I think
that's fiscal policy, not monetary policy, and that's your
job. Sustainable fiscal path, and the way that has worked when it's successful is you just get the economy growing faster than the debt. I think that we're going to need to do that, and that's going to need to happen, but it doesn't need to happen now. Now is the wrong time to be doing that.
Do you think we ought to go Catwoman on the budget and actually look for savings there?
Go Catwoman?
Not my job.
I don't know that reference. I think in the fullness of time, we will need to right-size our budget relative to our so that the economy is growing faster in nominal terms than
to sum up, not my job.
And the debt will have to eventually on the path we're on.
Well, do you think that deficits matter?
Certainly in the long run, I do believe they do.
You don't think they matter in the short run?
Again, I think we will need to return to this.
I get to call on Haggerty because he's waited so long.
We'll need to return to this issue. But I wouldn't return to it now. And the way to get after this issue is to get a situation where the economy is growing faster in nominal terms than the debt is.
What if that becomes the case, but your spending's also growing faster than your economy?
Well, no, that is the deficit. I mean, the question really is that the deficit is the difference between intake and spending. So it depends. It's the net of those two.
Let me stop you, Mr. Chairman, because I'm going to have one last question quickly. M2, the money supply, is up, I think, about $4 trillion over the past year. Or $6 trillion. 4 trillion, 6 trillion. What's a few trillion? It's up 26%, the highest amount since 1943. What does that tell you?
Well, when you and I studied economics a million years ago, that M2 and monetary aggregates generally seem to have a relationship to economic growth. Right now, I would say the growth of M2, which is quite substantial, doesn't really have important implications for the economic outlook. M2 was removed some years ago from the standard list of leading indicators, and that classic relationship between monetary aggregates and economic growth and the size of the economy, it just no longer holds. We've had big growth of monetary aggregates at various times without inflation. So something we have to unlearn, I guess.
Thank you, Senator.
Thank you, Mr. Chairman.
Thank you. Senator Cortez Masto from Nevada.
Mr. Chairman, thank you. Thank you, Chairman the Ranking. And Chairman Powell, thank you again for being here as usual. So enjoyed listening to you in the conversation so far. Let me bring up a subject that you and I quite often talk about, which is Nevada. And the tourism and service industry, as we all know, has been so hard hit. We have the second highest unemployment rate in the nation. In this type of labor market, there is no upward pressure on wages because when people are desperate for work, they're willing to take lower paying jobs. But when the unemployment rate is low, employers are more willing to both raise wages to find workers as well as invest more in in-house training and retraining. Can I just ask a question? How does a tight labor market encourage employers to invest in in-house training? Do you have any thoughts or answers to that at all?
Not my job.
I do. And as we've discussed, in that last couple of years when unemployment was routinely below 4%, as low as 3.5%, and where labor force participation was high, had moved up actually, despite expectations
under Trump,
that it
was
wouldn't. We saw lots of
okay,
virtuous
cool.
effects in the labor market. I actually talked about those a couple of weeks ago. One of them was, I didn't focus too much on, you saw employers investing more in training. You saw employers looking for people at the margins of the labor force. Employers were going to prisons and getting to know people before they came out and giving them jobs as they came out. Great things happening from a tight labor market. And I just think we saw that, and that's why one of the reasons we're so eager to get back to that, consistent with also maintaining price stability. But we really do think, and others saw the same thing we did, which is the broad societal benefits of a tight labor market.
And in particular, now, wouldn't you agree that Congress's investment in workforce development and helping?
Not my job.
That,
I will not offer commentary on Congress or their decision making.
I do. Again, I don't want to comment on any.
Come on!
I'm not entirely sure whether what you mentioned is in the current proposal, but I would say that the kinds of investment in people that enable them to be more effective in the labor force and policies that enable people to take part in the labor force, those are big things that can increase the productive capacity.
That's exactly what it is, Subtle.
Yeah, I agree. And without on the spot, that's why I've introduced the Workers Act, the Pathways Act.
Great, lady. Introduce an act that he's not going to offer commentary on. Stop talking.
Particularly now when we have an opportunity to have a long-term impact on jobs. So thank you for that. We jump to just the unemployment and service industry now. This is an area that I know we really hard hit. We have to do more to turn this economy around in our hospitality industry. But let me ask you this. If Congress does not extend and bolster unemployment insurance, what is the Federal Reserve's economic forecast for the impact on communities like Las Vegas that are dependent on travel and hospitality?
So again, I'm not going to comment on unemployment insurance as part of the bill, so I'm just going to stay away from the current fiscal discussions. I really have to do that. I mean, the single most important thing for your service sector employees is to get the pandemic behind us so people can get on airplanes and go to Nevada again and take vacations. That's the single most important economic growth thing that we have. I mean, after that, I think there'll be, and it's possible that that'll begin to happen, relatively soon if we can get the vaccines out and get people vaccinated and people do the right things with social distancing and masks and that kind of thing. You could see that happening relatively soon, which would be great.
I agree, but you would agree there's an investment that still needs to be made. I mean, we are not done here at the federal level with our monetary and fiscal policy and addressing the economic crisis we have. It's one thing to get the pandemic under control. It's another to understand how
your
we turn this
job, lady.
I would agree, and so we as I've said, we will keep our policy accommodative. We think we have a significant ground to cover before we get even close to maximum employment, and we hope to do everything we can to speed that process.
Here about making investments when some states turn around much quicker and their economy turns around much quicker than ours do, particularly in the service industry. No state should be left behind. And I hope that we would all agree to that we need to pull everybody with us as we address this pandemic and start to turn the economy around. So I know my time is up. I will submit the rest of my questions for the record. I also ask that Chairman Brown has had to get over to Senate Finance to ask a question. He will return. So I am going to sit in his chair temporarily, and I am going to go ahead and turn the gavel over to Senator Hagerty.
Well, thank you, Senator Cortez Masto. And I want to say a thank you to Chairman Brown and to Ranking Member Toomey as well for holding this hearing today as we work toward full economic recovery. And as noted, this is an important part of Congress's oversight of the Federal Reserve System. And Chairman Powell, I want to thank you for your time and your participation today. More generally, I want to thank you for your leadership of the Fed as we work our way through this crisis. And I want to say this, Mr. Chairman, I'm very encouraged by the indications from the Monetary Policy Report, progress that we're making as we come out of this downturn. We're looking at potentially north of 4% economic recovery, or as you and Senator Kennedy were just discussing, maybe even 6% growth for 2021. I find that very encouraging, albeit an uneven recovery. I feel that it's very good news that we're on the way. That also raises some concerns that I have, and I'm sure it's been discussed many, many times, about the amount of liquidity that we're going to continue to pump into this economy. We have already allocated $4 trillion in coronavirus recovery relief, $1 trillion yet to be spent, and now we're talking about putting close to an additional $2 trillion into the economy. I won't belabor this anymore. It's been discussed by my colleagues, but I share their concerns about injecting that much liquidity into the economy at a time when we're in the process of recovering, particularly noting our tough and slow recovery after the 2008 recession, given the amount of funding that was injected into the economy then.
Sorry, guys. That's his audio, not mine. Yeah, it has indeed been a crazy day so far.
Safer and cheaper payments. You and I have discussed the importance of the dollar as the world reserve currency on previous occasions. It's a vital asset for us as Americans. I would very much appreciate, Chairman Powell, your perspective on whether the Fed should develop a digital dollar that will be held directly by households, directly by businesses, and not intermediated by commercial financial institutions.
Thank you. So we are looking carefully, very carefully, at the question of whether we should issue a digital dollar. And it's something that central banks around the world are looking at, and
U.S.
doing
crypto
so appropriately, because the technology now enables us to do that, and it also enables private sector actors to create their own kind of digital quasi-money type of instruments. So there are significant both technical and policy questions to do with how we would go about doing that. I would say that we're committed to solving the technology problems and to consulting very broadly with the public and very transparently with all interested constituencies as to whether we should do this. I would also say we are the world's reserve currency, and we have a responsibility to get this right. We don't need to be the first. We need to get it right, and so but this is something we're investing time and labor in right across the Federal Reserve System. You may know that the Federal Reserve Bank of Boston has a partnership with MIT looking at one particular thing. We're doing research.
That's huge.
It does hold out the prospect of the things that you mentioned, very positive. It could help with financial inclusion as well. At the same time, you want to avoid creating things that might be destabilizing or that might draw funds away from the banking system. We have a banking system which intermediates between savers and borrowers. You know, we want to be careful about what the implications are of what we do. So a very high priority project for us.
I share your concerns on the need to be careful. I also appreciate the fact that you're going to stay at the leading edge of looking at this and making certain that America does not fall behind in any respect in terms of maintaining our status as the world's leader in reserve currency.
That's a great
question.
Just
a moment of time left. I want to follow up on a more technical comment that Senator Rounds made regarding the importance of looking hard at the SLR exemptions as we continue to move forward this year. I know they're coming to expiration at the end of March, but I very much appreciate your taking a hard look at that as we move forward, because there's a tremendous amount of liquidity coming in. And on inflation, you and I have talked before about the experience in Japan of disinflation. At the same time, I share Senator Toomey's concerns about the asset price bubbles that we're seeing already occur here in America. And again, I appreciate your role in taking a very steady hand in monitoring inflation and making sure we stay on top of it. Thank you very much, Mr. Chairman.
Thanks, wow, Senator. That was great. We got through one rep so far with a not my job.
Senator Van Hollen.
No, not my job.
Senator Brown is asking a question in finance. I'm going to ask a question in ENR. So I am going to also pass the gavel to Senator Van Hollen. Thank you.
Thank you, Senator Cortez Masto, and welcome, Mr. Chairman. Thank you for your service. At the outset here, I just want to underscore the importance of the Fed continuing to move ahead with the Fed Now service. As we've discussed in previous hearings, the United States' outdated payment system is inflicting large and unnecessary costs on millions of American consumers, leading to billions of dollars of unnecessary funds spent. And this doesn't impact people with big bank accounts who are not close to overdrawing. It impacts those who are living paycheck to paycheck. So I see that the Fed has accelerated its timetable a little bit to 2023. If you can move even faster, all the better. You'll be saving millions of Americans lots of money in unnecessary costs. I want to focus my questioning on the issue of long-term unemployment. And in a speech you gave on February 10th, you pointed out that the unemployment rate would be close to 10% if you adjust for the Bureau of Labor Statistics, misclassifications, and people who dropped out of the labor force since the pandemic. This includes over 40 million Americans who are counted in the unemployment figures, but are long-term unemployed, and millions more who've dropped out of the labor force during the pandemic, but would like to get back into the workforce. And you noted in that speech the concerns of persistent and damage from persistent long-term unemployment, what it inflicts on workers personally and their families, and
he'll get to a question eventually,
negative impact on productive capacity for our entire economy. And you stress that monetary policy alone can't do this. It requires a fiscal response. So here's my question. Beyond the overall impacts that the bill were before us or other fiscal responses will make in terms of increasing overall economic growth, based on your experience, would you agree that it's important to very intentionally develop policies to help the long-term unemployed, individuals who even during good economic times were unable to get into the workforce?
Do you think it's a good idea to create fiscal policy that targets the biggest issues facing the economy?
I would say, but it's particularly relevant now. As I also mentioned in those remarks, industries are always, growing and shrinking, and workers are moving from one industry to another. That's just a market-based economy working. In this situation, you have that accelerated in a big way. And so many of the people, we may find that many of the people who are not going back to work or not back at work now may really struggle to find jobs because businesses are being automated. We hear that all the time, that computers and sort of automated answers are becoming more and more common. So I think those people are really going to need help to get back into the labor force and get their lives back. So, and that will take, I think,
because Powell can't look at them and go, "That's a bonehead question."
No,
You're an idiot.
That. And we're talking about a focus and an intentional investment beyond the investments that we're making for overall economic growth, right?
Yes.
Yeah. And I also wanted to turn really quickly to the importance of using the right kind of economic measurements to determine the well-being of American workers and families. As you noted in that same speech, unemployment among low-wage workers is 17%, where it was at the start of the pandemic, whereas among high-wage workers, it's only down 4%. So if you take the average, you're not seeing the impact, the disproportionate impact on low-wage workers. I often give the example that if Jeff Bezos had moved to Baltimore City last year, the per capita income of Baltimore City would have gone from $53,000 per person to $175,000 per person, even though nobody was better off individually. So what should we be doing, and what is the Fed going to be doing to make sure that as our economy improves, which we all want it to do quickly, we don't overlook the continuing pain people are feeling because we're looking at averages and not looking beneath those averages?
These people who are struggling in that way are doing so because
they
were employed
Powell
in
did
public-facing
confirm the
jobs
Fed
and
is
service
actively
industries.
pursuing
So clearly, the number one thing we
consideration
can
for
do
a
to get
digital
them back to
US
work
dollar
is to get the pandemic behind us, and that's not something we can work on here at the Fed. But that's the top thing.
That's
Beyond
not
that,
my
I
job,
just
by the
think
way.
it's up to us to continue what we can do to support the economy for really with some patience in order to so that they'll have time to get across. We've talked about a bridge. Most Americans will have a bridge in the end, but there's a group that will really struggle, and I think we need to be mindful of them because really they did nothing wrong. This was a natural disaster, and as a country we set out to provide support.
I appreciate that. And I hope as the Fed releases its numbers going forward, in addition to the aggregate average numbers, you also continue to provide us with the impact on lower wage individuals. Thank you, Mr. Chairman. Senator Tillis. And if Senator Tillis is not with us, Senator Loomis. And if Senator Loomis is not with us, Mr. Chairman, is Senator Tillis, I'm told, maybe joining us soon?
Oh my gosh, come on, guys. You have one job. One job.
Moran.
Thank you, Mr. Chairman. Mr. Chairman Pro Tem. And Chairman Powell, thank you for the opportunity to visit with you today. And thank you for your work at the Fed. Just a broad question. How do you view your job in relationship to an administration? So a change in administration from one president to the next, what does that mean at the Federal Reserve from your perspective? Anything or a lot?
Well, our job doesn't change. And at the very beginning of the administration, the personnel don't change. Of course, the one way that administrations really do interact importantly with the Fed is with appointments. And so those will happen over time. And the second thing is, it's a different group of people. We have ongoing relationships by long-standing practice with various parts of the Treasury Department mainly, but also to a much more limited extent with the White House, and we make new relationships and continue to have the same sorts of discussions that we have. But ultimately, the answer to your question is nothing really changes because of the election other than meeting new people.
Chairman, thank you. And thank you for your answer. During my time in the Senate Banking Committee, I've been an advocate for an independent Fed and want the Fed to make decisions based upon best policy without significant political interference, other than perhaps the Senate Banking Committee, anytime that we can take that opportunity. Let me ask a specific question. The most recent monetary policy report to Congress the central bank indicated that, and I quote here, commercial real estate prices remain at historically high levels despite high vacancy rates and appear susceptible to sharp declines, particularly if the pace of distressed transactions picks up or, in the longer term, the pandemic leads to permanent changes in demand. I have great concern for the commercial property markets and would like to hear what your thoughts are. Is this something we need to wait out? Is it something that needs more attention than we were been able to provide in CARES or COVID relief before? And what does it mean to CMBS borrowers in this market, with this market?
Well, some parts of commercial real estate, office, hotel, and some maybe retail to some extent are under real pressure because of the pandemic, and those changes may be lasting, or they may be temporary, or they may be somewhere in the middle.
All right, guys. On that note, not much news happening. They can't even afford to show up for the meeting at this point. Powell's knocked it down. The digital currency, I'm glad we were around for that question. That was the only really solid question that I heard pretty much through this entire damn thing. But there you go. U.S. digital dollar is something actively being considered, studied, and pursued by the Federal Reserve, which is great. Everything else is exactly the same. That was the only thing that I got wrong. No, not necessarily Bitcoin to the moon. That could actually be a deflationary event to Bitcoin. If a U.S. has a digital currency, people are more likely to move out of Bitcoin into that digital currency. So that would be the only thing that I got wrong about this. I did not foresee anybody having a digital dollar question, but the rest of it was pretty much the same. Stay the course. We're ready to pump. Not my job, not my job, not my job. So that is phenomenal. Let's open up Twitch here and see who is live right now. Bum, 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 bum. You guys want to go hang out with Stock Jock? Oh, Rita's live. I didn't realize Rita was live. I'll send you over to hang out with Rita. I'll send you over to hang out with Rita. Rita's good times. 10 seconds. 8 seconds. 7 seconds. 6. 5. See you. No stream tomorrow, guys. I'll see you Thursday. Tomorrow's F Wednesday. Later.
Monil, do you remember that day that that person liquidated their portfolio in IB because they restricted people from trading AMC, GME, and etc.?
Yeah.
Do you know what date exactly it was? Because I think what happened was that it was publicly posed as an altruistic stance, but I think it was actually